Do you want to invest in one of the most bulletproof businesses out there? Like the idea of making money while you sleep like a baby? Want to collect dividend income that's twice as high as what the stock market offers? Then you have to check out today's video. Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is providing electricity to millions of captive customers. I say captive for a reason. After all, you can't really live in modern day society without electricity. The very machine you're using to watch this video is powered by, you guessed it, electricity. And utility stocks like the one I'm featuring today make a lot of money and pay out a lot of dividends because they're providing that necessary electricity. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of American Electric Power Company, Inc., which appear to be trading at a significant discount today. American Electric Power Company, Inc., stock ticker AEP, is an American electric utility holding company that, through subsidiaries, provides electricity generation, transmission, and distribution to more than 5 million retail customers across 11 different states. Founded in 1906, American Electric Power Company is now a $39 billion by market cap regulated utility monster that employs more than 17,000 people. The company reports results across 4 primary segments: vertically integrated utilities, 56% of fiscal year 2019 revenue, transmission and distribution utilities, 27%, generation and marketing, 11%, and AEP Transmission Holdco, 6%. A corporate and other segment has insignificant revenue. Fiscal year 2019 utility retail revenue can be broken down by customer type: residential 48%, commercial 28%, industrial 22%, and other 2%. The company primarily relies on coal for energy generation. Coal accounts for 45% of their generating capacity, while natural gas represents 28%. Most of the remainder comes from renewable sources such as wind and hydro. The investment thesis for a power utility business is extremely straightforward. Simply put, our modern society cannot function without dependable access to electricity. Utilities that provide this service naturally profit from their role, and investors who own shares in high-quality utilities profit too. Investors can also usually count on some of the most reliable growing dividends out there due to the innate need for power. As it stands, American Electric Power Company has increased its dividend for 11 consecutive years. The 10-year dividend growth rate is 5.2%, and this growth rate has been remarkably consistent over the last decade. For example, the most recent dividend raise was 5.7%. This growth rate certainly isn't stratospheric, but it is rather strong when pairing it with the stock starting yield of 3.8%. That yield is more than twice as high as what the market offers. It's also 50 basis points higher than the stock's own 5-year average yield. And with a payout ratio of 76.7%, the dividend remains easily supported by earnings. Great dividend metrics here. We have a fairly large dividend growing at a mid-single digit pace. One can do much, much worse than this. Looking at business growth, the company grew its revenue from $14.427 billion in fiscal year 2010 to $15.561 billion in fiscal year 2019. That's a compound annual growth rate of 0.84%. Meanwhile, earnings per share moved from $2.53 to $3.88 over this period, which is a compound annual growth rate of 4.87%. This is fairly typical growth for a large regulated utility business. Looking forward, CFRA believes that American Electric Power Company will compound its earnings per share at an annual rate of 6% over the next 3 years. That would be an acceleration in earnings per share growth relative to what the utility has recorded over the last decade. CFRA cites customer growth, higher rates, and higher transmission volumes as tailwinds. The work from home theme should positively impact residential numbers. Notably, the utility is executing a substantial spending plan, $35 billion from 2020 through 2024, which should result in higher rates, revenue, profit, and dividends as costs are passed on to customers. This is a utility that will have to spend in the future as the large reliance on coal for generation capacity has to be reduced. Whereas you could look at the current coal exposure as a negative, the move toward an energy mix improvement is a growth opportunity for them. American Electric Power Company has already stated that it expects 24% of its generation capacity to come from coal in 2030. Simultaneously, they expect renewable energy capacity to jump to 39% by 2030. I think CFRA's near-term earnings per share growth projection is reasonable, and that would translate to like dividend growth over the foreseeable future, which is more than enough when paired with a near 4% yield. Moving over to the balance sheet, the company's financial position is okay. It's not out of line for a utility. However, I do think there's room for improvement in this area of the business. The long-term debt-to-equity ratio is 1.28. The interest coverage ratio is just over 2.5. Profitability is solid and well within a range of what I'd expect for this kind of business. Over the last 5 years, the firm has averaged annual net margin of 10.68% and annual return on equity of 9.10%. This is about as bulletproof as a business model gets due to the innate need for the electricity it provides to millions of customers. And with scale, a unique regulatory structure that almost guarantees profit, and the ability to operate as a local monopoly within its service territory, the company does benefit from competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. Competition is essentially nullified by a geographic monopoly. On the other hand, governments heavily regulate electric utilities in exchange for being able to pass on costs and offering necessary service to a captive customer base. A utility business must accept a limit on how much profit they can actually make. In addition, new future competition could arrive in the way of customers becoming competitors. This would happen if power is able to be easily and cheaply generated and stored at the consumption site. Technology advancements in solar cells and batteries are a big risk to electric utilities. There's also geographic risk. A utility company cannot expand its coverage area very much, so underlying growth within its established service territory is very important. I also see some reputation risk in the form of coal exposure. While the company continues to move away from coal, its heavy reliance on coal for energy generation could lead to some customer dissatisfaction. Overall, even with these risks known, I think this regulated utility business is highly attractive for income-oriented investors, and the stock's low valuation makes it particularly attractive right now. The stock has a price-to-earnings ratio of 20.2. While that might actually look high, keep a couple things in mind. First, it's lower than both the broader market and the stock's own 5-year average PE ratio of 28.0. Second, impairments largely related to plant closures has reduced trailing 12 months GAAP earnings per share. This has had the effect of skewing the PE ratio higher. Meantime, the price to sales ratio is right in line with its 5-year average, and the yield, as noted earlier, is notably higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 6%. This is on the low end of what I tend to allow for in a dividend discount model analysis. However, it's also within a range of what I normally ascribe to a regulated utility such as this. These are slower growing, higher yielding stocks that are perfect for investors looking for income or aiming to raise the overall income profile of their portfolio. I think this is a warranted dividend growth rate. It's very close to where the most recent dividend increase came in at, and CFRA is calling for near-term earnings per share growth to come in at this exact level. Looking at the overall growth profile of the business, this seems like a very reasonable expectation. The dividend discount model analysis gives me a fair value of $78.44. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates AEP as a 4-star stock with a fair value estimate of $89. CFRA rates AEP as a 3-star hold with a 12-month target price of $98. I came out on the low end this time around. Averaging the three numbers out gives us a final valuation of $88.48, which would indicate the stock is possibly 13% undervalued. Here's the bottom line, guys. American Electric Power Company, Inc. is a high-quality regulated utility that provides a necessary service to millions of people with a secure yield near 4%, more than a decade of consistent dividend raises, and healthy dividend growth. This near bulletproof dividend growth stock is a compelling idea for income-oriented investors. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also, take a look at the description box below for some important links, including a link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.